Jacqueline here, your Point Mortgage Loan Officer. Today I want to talk to you guys about ARMs. No, not that kind of ARM. I'm talking adjustable rate mortgages. An adjustable rate mortgage is otherwise known as an ARM, is a home loan with an interest rate that adjusts over time based on the index. ARMs typically start at a lower interest rate, and that initial interest rate is fixed for a certain period of time. After that, the interest rate applied on the outstanding balance resets periodically at yearly or even monthly intervals. An ARM has four components: the index, the margin, an interest rate cap structure, and an initial interest rate period. The index and the margin go hand in hand. When the initial interest rate period has expired, the new interest rate is calculated by adding the two together. The margin will stay constant throughout the life of the loan, meaning it will never change. However, the index will move up or down based on the Treasury securities or the cost of funds index. Now let's talk about caps. There are three different kinds of interest rate caps. The initial cap limits how much your rate can increase when your rate first adjusts.
Periodic cap limits how much your rate can increase from one adjustment period to the next.
Lastly, you have your lifetime cap. The lifetime cap limits how much your rate can increase or decrease over the life of the loan. There are different types of ARM loans and several different arrangements to choose from. For example, you have a 5-1 and a 5-6. Those offer a fixed rate for the first 5 years of the loan. The second number refers to how often the rate adjusts after that initial term. For a 5-1 ARM, the rate adjusts once a year. With a 5-6 ARM, the interest rate will adjust every 6 months. There may also be rate caps associated with the loan. In the real estate industry, you may see the term 225 used to refer to a 5-1 ARM. The second set of numbers, 225, refers to details of your rate caps, which include the initial cap, the subsequent or periodic cap, and the lifetime adjustment cap. Let's move on to the 7-1 and 7-6 ARMs, which offer you a fixed rate for 7 years. With a 30-year term, that would lead to fluctuating payments for 23 years after the initial fixed interest rate expires. Then we have our 10-1 and 10-6 ARMs. These will have a fixed interest rate for the first 10 years. After that, the interest rate will fluctuate based off of market conditions. If you take out a 30-year term, that will lead you to have 20 years of changing payments. Like and follow for part 2, and we'll discuss a little more about how to qualify for an ARM, the pros and cons, and whether or not an ARM is the right product for you. Until then, if you have any questions, please don't hesitate to reach out, as I'm always happy to help. And that's it for today. See you guys next time.